Bloomberg Audio Studios. Podcasts, radio, news.
It's been a bewildering week for retail investors trying to make sense of global markets. After U.S. President Donald Trump unveiled sweeping new tariffs, we saw $10 trillion in stock market value disappear.
The U.S. president is doubling down on an economic policy that most economists think is de-anchored from reality.
Then came Wednesday's stunning rebound.
A remarkable rally we're seeing in the markets right now, up nearly 10 percentage points on the NASDAQ.
And today, markets have slid again.
Yesterday's tariff reprieve did not last long, with U.S. stocks resuming their decline, bonds not getting much love, the dollar sliding, and corporate credit default risks rising.
Meanwhile, the U.S. and China, the world's two largest economies, have continued to ramp up the pressure on each other with a series of compounding tariffs. President Trump's tariffs on Chinese imports have reached 145%, factoring in a 20% levy placed on China over its role in fentanyl trafficking. And China has said it's raising tariffs on U.S. imports to 84%. Bloomberg's Charlie Wells says all of this creates a lot of uncertainty for businesses, which translates into uncertainty for investors of all kinds.
We actually had a Bloomberg report about Walmart telling a company just a few days ago in China not to put sticker prices on Christmas ornaments because there's just so much uncertainty about how much things are going to cost come Christmas. So, beyond 90 days, beyond this pause that Trump has put into place, there's still going to be a lot of uncertainty, and that's probably going to play out in the stock market too.
As a personal finance reporter, Charlie hears from a lot of people looking for guidance from experts on what financial moves they should be making. And he says these past few weeks, everyone's been wondering the same thing.
So the big question that I get is really simple, but it's a really hard one to answer. And it's, what should I do with my money right now?
I'm Sarah Holder, and this is The Big Take from Bloomberg News. Today on the show, in the midst of all this uncertainty, we're going to take a look at your money. We'll hear expert advice on what to do with it right now and in the weeks and months ahead. Wild swings in the stock market are anxiety-inducing for all kinds of investors. So if you're nervous, you're not alone. Charlie says he's heard from a lot of readers this week, including someone who did the one thing financial experts really don't want their clients to do.
She said that she was so relieved that she sold out of her stock portfolio. And this was someone in her 30s. This is someone who has a long time horizon, who, any expert would say has a really high risk tolerance. Instead of kind of staying in the market, as most financial advisors would recommend, she sold out and is sitting in cash. And that's kind of not the sort of thing that you're supposed to do, but it represents the level of fear that there is in the market right now. It represents the fact that people are really trying to navigate the uncertainty right now. And a lot of people think that that's just being in cash, but that's not a great idea. And we just have so much data on that. When you sell, you lock in the loss. But when you stay in the market, it's just a paper loss that very likely is going to recover.
What about if you have less risk tolerance? If you're older, say, if you're nearing retirement?
This is one of the issues that has been really difficult lately. People who need to sell because they are going to leave the workforce, because they are retiring. And a lot of people had asked, how much stock should I have? Is this market going to keep going up and up and up? And a lot of, people who were nearing retirement, I think, were maybe a little bit overly optimistic about the trajectory of the stock market, because one of the things that we know is that, it does recover after downturns, but it also turns down. And so just getting caught up in some of this timing, I think, has been difficult for a lot of retirees. And there's been this temptation over the past 2-3 years, as we've seen this huge stock rally, to maybe over allocate to stocks, because it seems like the good times are going to keep on rolling. But as we learned over the past week, they're not.
Well, one of the things that investors have been paying particular attention to, something we covered on The Big Take yesterday, were the swings in the bond market. Earlier this week, we saw the sell-off in U.S. Treasuries, which sent yields surging. Can you explain why that's such a big deal?
It's a big deal because it was really unusual. And so usually what happens is when there's a lot of fear in the stock market, investors want to go someplace safe. They want to go someplace where they know that, they've got the full faith and credit of something that's really responsible. And usually that is the US government bond market. Those are US treasuries that people tend to turn to. And so when stock prices go down, people usually want US treasuries, these bonds. And so those bond prices go up and then the yields go down. But this past week, something really weird happened. And it was that as stocks went down, prices went down, which meant that bond yields went up. And this is just not something that we're used to seeing in financial markets.
Well, if U.S. Treasuries are looking less safe, what does that mean for the typical 60-40 split many of us think of as classic investing advice for portfolios?
Yeah, so I think that, the 60-40 is a very, time-tested strategy. It's been under pressure over the past few years of kind of getting the right mix between stocks and bonds, getting risk from stocks, but the safety of bonds. And I think if there is this belief that U.S. treasuries are not as secure, as we've known them to be for so many decades, that maybe that strategy isn't a smart one. But I think it's too soon to call for the end of the 60-40 portfolio. I think that one point that financial advisors always make to me is just because you're seeing one day this highly unusual event in markets that could look like evidence that people no longer have full faith and confidence in the United States, that there's concern about the creditworthiness of the United States, you might feel that one day, but then the next things start to recover and we move on. And so making a kind of drastic change, kind of changing some of these fundamental assumptions that we have can be really dangerous.
I want to make sure people understand the significance of higher yields in the bond market. How might that show up in people's everyday lives?
Yeah, so, the everyday person isn't necessarily sitting around thinking about the yield on the 10-year treasury, but 10-year treasuries are really important because they're benchmarks for a lot of the consumer products, the kind of consumer borrowing that we see in the everyday economy. So the 10-year treasury is used as a benchmark for 30-year mortgages. It influences student loan borrowing rates, credit card rates. And so it really does trickle down into the everyday economy. So if you're seeing that yield go up really high, that means basically that, mortgage prices will eventually be higher, that the amount that it costs to borrow will be higher because that benchmark that so many lenders use has gone up.
So, Charlie, people are coming to you asking, what should I do with my money right now? Bloomberg recently published a piece about investing in times of market uncertainty. And one thing that the experts who spoke to Bloomberg encouraged everyday investors to do was evaluate their portfolios. What does that actually look like in practice? And what do experts say people should do right now?
Advisors usually say, before you make any moves at all, before you try to take advantage of moves in the market, before, you try to buy the dip, as we hear a lot of people talking about, you just want to make sure that you're in a really safe, comfortable financial position where if the uncertainty in the stock market translated into, say, the job market and you were to lose your job, you would be okay for the length of time that it might take for you to find another job. And so really step one, whenever we're in a time of uncertainty, is to make sure you got an emergency fund. That number on the emergency fund varies from as little as 3 months to a year. But advisors really say you want to have 3 months to a year's worth of salary socked away just so you can absorb any shocks. So that's kind of step one. And even if you've got that, even if you feel like your savings are pretty good, something that you can do in a moment like now is just to kind of take stock, just to check in. I think a lot of times we've got, some savings in one bank account. We've got, I bonds somewhere else. We put, the 401k in another, and just kind of getting it all organized really is step one.
One of the first steps for people right now might be to take stock of where they're at. But something we keep hearing is don't look at your 401k. Is there a point at which that changes? Is there a point where financial advisors say people should jump in, should look closer at their 401ks in a time of market uncertainty?
Yeah, so advisors don't like people to look at their long-term investments because, historically we know that stock markets recover, that anyone who does look at their 401k now is probably going to see a really disappointing dip. But that doesn't mean that you can't do nothing. And I think one of the points that I've heard from experts over the past few weeks is, now could be a good time to kind of reassess your investment strategy and dollar cost average if you do want to make some kind of change. And so what that means is instead of, say, dumping a bunch of cash into the market right now, you might take a certain amount and put it in over a fixed amount of time. So say instead of putting, $10,000 into the stock market right now because you think prices are really good, you might put $2,000 into the market for the next 5 months. And what that does is it helps you get access and exposure to the stock market, but without necessarily risking the fact that stocks could keep going down from here, right? I think that's one of the main concerns, and that's one of the reasons why advisors don't like people, looking at these long-term investments too much, because it could make them feel like, oh my goodness, Apple's down, Tesla's down, everything's down, I'll get a great discount. Dollar cost averaging allows you to kind of, yes, clock some of what seems like a discount now, but then also hedge the fact that these stocks could be discounted even more in the future.
So it's not just don't look at your 401k because it might make you super anxious. It's don't look at your 401k because you don't want to make rash decisions.
That's right. But also, you can make decisions and you can look to see, maybe I'm not as comfortable with how much equity I have in my portfolio. And what one really smart advisor told me was use this as a little bit of a test, as a sign. Like, how did the past week make you feel? Were you comfortable seeing that 401k go down? Or was it just too much? And if it was just too much, you might need to change into less risky assets. You might need to think about maybe more bonds. You might need to think about holding more cash. It's just sort of a sign that maybe the way that you've allocated your portfolio isn't right for you.
So that's what experts are saying you do right now to get through this period of market uncertainty. But what about down the road? That's next. On Wednesday morning, just before the White House announced a pause of some tariffs that sent markets surging, President Donald Trump posted on Truth Social. "Be cool," he said. "This is a great time to buy." I wanted to ask Bloomberg personal finance reporter Charlie Wells if he was hearing the same from financial experts. Should everyday investors start moving money into the market?
So I'll give you a qualified yes, and it's not a terrible time to buy the dip if, and this is a big if, you have the time horizon, you have the risk tolerance, and you have the cash to do it. So the big picture idea here is that when the stock market goes down, in a lot of ways, it means that a lot of high quality companies that maybe were, overvalued, that maybe were just expensive, their prices come down. And there's a high likelihood that at some point in the future, maybe even the near future, their prices will go back up again. And so if you're someone who has their emergency fund covered, if you're someone who has paid off high interest debts, then maybe this is something that you could think about. And really, kind of in the broadest strokes, people who are further away from retirement, who have a lot more time for the stock market to recover, are in a position where they could do this. And so, yes, every financial advisor that I called this week told me that now could be a good time to buy the dip if you do it in a responsible way.
Are there any industries that financial experts say are better, safer bets right now? Any industries that have generally been recession-proof?
So I get a lot of vanilla answers when I ask about this, and advisors are always really reluctant to tell me, go into this particular industry. One advisor in California talked about how, there is some concern about the direction of the U.S. And if that is a conviction that you have, you might want to look at global companies, global indices as well. And then, generally in times of recession, people talk about, investing in areas that consumers consumers are still going to spend on, even if they've lost their jobs, right? So that would be consumer staples, healthcare, the sorts of things that people need to buy regardless of how flush they're feeling. But the important thing here really, and this comes up all the time, and I think it is because it is good advice, you want to be diversified. And it's so fun to think that you've got the insider info on one particular company, but the high probability is you might not know as much as someone whose entire job it is to follow stocks, to follow a particular company. And so diversification really is important.
Well, right. What about other places to invest your capital outside the stock market, like buying property or buying commodities like gold? What do experts say the move is there?
So, I think for the average investor, it's really hard to find, the right balance. I think diversification is important. I think a lot of portfolios, especially for younger people, probably should be, more in stock than almost anything else. But we're inundated with finfluencers, with internet articles about, storage units and rental properties and all of this stuff. And one very real conversation I had with a financial advisor, we addressed these kind of alternate investment ideas. And what he told me was, if you want to invest in something, the best thing that you can invest in is your job, because you know what the return is going to be on that investment. You know what the risks are. And actually, the amount of money that you get from your job is probably a lot more than it's going to be from a storage unit business that you take part in. And then thinking about things like gold, it's reaching peaks right now. I think people have tried to count out gold for a long time. Obviously, owning physical gold is more challenging than stocks. There are ETFs, of course, that you can buy. But, small allocations here, I think really kind of sticking to the bread and butter is what most mainstream advisors would recommend.
That's so funny. He's like, get off TikTok, stop browsing commodities markets, just do your job.
Literally that.
Well, it's really hard to time the market, as we've been talking about, especially in a volatile, whipsawing period like this. But what about timing other money moves? We've been reporting at Bloomberg on some consumers panic buying certain products. What do the experts say about these sorts of purchases, whether it's a car or like a home appliance, like an air conditioner?
So the best practice is to ask yourself, do you need it and can you afford it? And if you can answer yes to both of those questions, you should probably buy it. But there's a flip side here where, some economists have been saying that these tariffs could eventually lead to a recession. In recessions, companies often have to discount because demand goes down. So you don't want to get into a position where you've rushed to buy something to try to beat tariffs, and then this hypothetical world of a recession sets in, and then things get cheaper.
I asked you last time we spoke about whether pulling out of the stock market altogether would be a strategic move, if the safest place for your money was under your mattress. You said advisors were saying essentially, keep putting a steady amount into the market over time, in part as a hedge against inflation. What about now? Has anything changed?
I would say no. In fact, I would say that the standard advisor who knows that you've got all your bases checked would say, keep investing, keep going. Because even in the past few days, we've seen these significant drops. But as we've been talking about whipsawing, we've also seen recoveries. And that is kind of, in a nutshell, what happens in the stock market. It feels like decades have been compressed down into days. But if you take what's happened over the past few days and then stretch it out over many decades, that's what happens. It goes up, it goes down, and then it goes back up again.
This is The Big Take from Bloomberg News. I'm Sarah Holder. This episode was produced by David Fox. It was edited by Patty Hirsch and Brian Chapata. It was fact-checked by Adriana Tapia and mixed and sound designed by Alex Sugiura. Our senior producer is Naomi Shavin. Our senior editor is Elizabeth Ponso. Our deputy executive producer is Julia Weaver. Our executive producer is Nicole Beamsterboer. Sage Bauman is Bloomberg's head of podcasts. If you like this episode, make sure to subscribe and review The Big Take wherever you listen to podcasts. It helps people find the show. Thanks for listening. We'll be back tomorrow.